Yeah. Thank you very much, control room and the officials of the SciTex. Uh, uh, Shri SP Singh from IRS joining us. Then friends from our Vancouver chapter and a very old friend Ganesh Bhai, my vice chairman Kothari. Then we have vibrant Vivek Kapoor ji and Deepak Bhai, then Akash ji, and two speakers, Niyal ji and Mantra ji. And the moderator of today's program, my son Rishabh, uh, and the technical team of the ICI making it possible for today. Friends, I just give you a brief background about why this has come to my mind that we need to have a common program between two countries for the reason that the presence of our own friends in that country is also important that we must know that how many of our fertility is there in the Canada, both Vancouver and Toronto. Uh, because I visited in 2018 both these places for one of the your program, annual program, which you do. And when the SciTex responsibility was given to me, at that time, what I feel that uh, the inbound development in the Canada is not much known to the Indian people over here, and outbound sometime if the Canadian people they wanted to invest in India and they wanted to know about the intricacy, the development in the core taxation field, especially in the international tax, that is not much known. So to begin with something, initially we have done one with the Qatar, and then the Canada, both Toronto and Vancouver, they took the initiative. A lot of efforts have been put by these two leaders. Let me tell you, friends, sorry, Gaurav, for just looking now. Gaurav Singhal, my good friend, is there, as you are not visible in your photo. So, left. So, friends, when I talked to SP Singh ji and some of our friends in the leaders in the Toronto and Vancouver chapter, so I found it that this could be a beginning where we can discuss some of the things within 2 hours. And as such, we are choosing a time. I know it is a bit early. Good morning over there. And we are having the towards the good evening. And as such, both the viewers of the India as well as the Canada and other overseas chapter, if they have some issues over there, so that can be addressed over there. So just give the flow of the program, then the Risha will see and SP Singh sir will see to it that everything goes well and the speakers are taking their time. I will, before I say that the welcome address will be given by Ganesh Bhai and the special address will be from Vivek Kapoor ji from Toronto. Then we have speakers from the countries Vancouver and Toronto chapters of the Canada. Deepak Bhai will be there. The Mantra ji will be there, and Ashok Lakotia ji will be also dealing in the from the Canadian side. And then we have friends from senior friends K.R. Giri ji from India, and then Gaurav Singhal ji from India, both dealing on the Indian side. Before I formally say anything. If anything is not up to your expectation, please do not hesitate to write us. I believe in 3C. First is your complaints. The second C is your comments. And the last one, which we always say, that though we do not require any compliments, but if you still wish, but we are interested in listening more of the improvement side at the committee level. So may I request my vice chairman to say a few words, and then we'll have the beginning of the program. Kothaji?
Yes, sir. Good evening, members. The chairman of SciTax and the chapter in charge of Vancouver and Canada Toronto branches. It's really heartening to have a joint program from India and covering Canada and Vancouver. It's a new beginning, I should say. Let us continue this particular program, the series of programs. We have learned speakers who can share their knowledge on the TTAs between Canada and Vancouver. We have a good friend of ours, CA K.R. Girish. Welcome to you, sir. So SP Singh sir is also there. So let us enjoy this program and learn more about international taxation. And this Committee on International Taxation under the leadership of CA Sanjay Kumar Agarwal are willing to do many such programs for the benefit of members at large. Thank you once again for this particular program and associating yourself with the Committee of International Taxation. Thank you, sir.
Thank you, Vice Chairman, sir. Now, can I request Ganesh, sir, to give us a few words?
Yes, very much. Thank you, Rishabh. Thank you very much. So, hello, friends. Very warm welcome and very good morning from Canada. British Columbia chapter of ICA is very happy to welcome you all at this professional development event being organized jointly by British Columbia chapter, Toronto chapters, and Committee on International Taxation of ICA jointly. I would like to express my regards and sincere thanks to all present, Chairman and Vice Chairman, Committee on International Taxation, Chairman, Toronto chapter, session moderator, esteemed panelists, and last but not the least, our esteemed participants attending the event live and globally. Friends, this is indeed an opportunity for all of us to promote businesses between our two great countries, India, our home country, and Canada, our adopted country. Foreign chapters, as you know, of ICA play a very key role in this business promotion and trade and services promotion. Our chapter of British Columbia is indeed very privileged and excited to help the promotion of trade and business services between Canada and India. We have experts like Deepak Arora, Raj Mantra, Akash Lakhotia, and many other such professionals who advise businesses and entrepreneurs to set up shop here in Canada. We are very happy to help. You would be listening to them very soon. From the promotion of business and trade perspective, they will explain how we as ICA chapters in Canada and in our respective individual capacity we can help. Other than the business and trade help, as the panelists will be talking on, how British Columbia chapter can help fellow Indian CAs who are immigrating to Canada. So there's some things that we are doing here in British Columbia, and I want to speak a little bit on those. So one, we mentor Indian CAs, be they are already in India or Canada or globally anywhere. We help them to get job opportunities. We provide coaching assistance for preparing them for CPA Canada exams. We organize networking and professional development events regularly. And friends, I'm very happy to say we have promoted networking between ICA OC chapters in North America. I'm very pleased to inform that I personally signed MOU between Toronto, San Francisco, and British Columbia chapters. So I believe with these few words, I would like to pass on the control to Rishabh. And just want to add one more thing, friends. I just missed it. I want to say we are very privileged and we are very honored to say, I'm tempted to say that we are one of the probably the only chapter of ICI in Canada or globally who has received consecutive 7-year chapter best award. So thank you very much. I would pass on the control to Rishabh.
Thank you so much, Ganesh sir, for your words. Now, can I request Vivek Kapoor ji, who is the chairman of the Toronto chapter, to say a few words?
Thank you, Rishabh. So, hello everyone. Good evening in India and good morning in Canada. I am very privileged and honored to be part of this event being conducted by the Committee of International Tax, and special thanks to Sanjay ji and the entire team on his side to help coordinate and conduct and organize and ideate this program. Uh, uh, for the benefit of this chartered accountant fraternity, whether in India or Canada, this will be a landmark event and will be a lot of knowledge sharing. I also want to thank speakers from Toronto chapter of ICI, Dr. Rajendra Mantra, who's the past chairman of the chapter and the current treasurer, and Akash Lakotia, who's the current board member, young and dynamic and very detailed insight person in taxation. We always, as chapter, refer to him for taxation inquiries, if any. And also Mr. Deepak Arora, the chairman of Vancouver chapter of ICI, and our very good friend and supporter. And obviously, he's been in practice for, I think, 2 decades plus, and a great pool of knowledge he has. So I'm sure this event will benefit everybody who's attending. And I don't know if the recording is shared later on. People who are not able to attend right now, they will be able to take benefit from the knowledge of the speakers. I would like to just mention, for the benefit of our people here, that Toronto chapter of ICI is conducting one of its first kind event in North America. This is called the North American Talent Summit. This is happening on 7th October. We are trying to get, when the event happens, those who are physically can attend will attend, but those who cannot, we will share the recording, and I will encourage the Central Council to share it with the branches for the benefit of those who cannot attend it later on, so that they can understand. Because as Ganesh ji mentioned, when immigrants come to Canada, we face a lot of hurdles in terms of getting job opportunities. So in this event, we are getting 6 HR heads of big corporations in North America and deliberate on the topic of Canadian experience, how to get a job in Canada when Indian chartered accountants come here, what are the skill sets they bring to the table, and what is the gap that has to be bridged. Because employers here expect something, and our members come here with great skill set, but then there is a bridge to be covered. And that bridge will be discussed by 6 top HR heads in this panel discussion happening on 7th October. And we will share the brochure. And Sanjay ji, I would appreciate if you can, through the council, circulate to all the members and those, make them aware about such an event happening. And recording will be shared later on.
Certainly, boss.
Okay, thank you, sir. And with these words, I'll pass it on back to Rishabh for taking the program further. Thank you.
Thank you. Thank you so much, Vivek, sir. Before I formally introduce the speakers or the panelists for the discussion, can I request SP sir, who is the mentor over here, to say a few words.
You are on mute, sir. Sir, you are on mute.
Sir, we cannot hear you.
Am I audible?
Yes. Now.
Yeah. So the relationship between India and Canada is very strong. I mean, approximately 4% of the population in Canada, which is approximately 14 lakh, come from India. And now Canada is gradually developing as one of the most favored destinations for the students from India. And when the trade is growing between the two countries, the taxation becomes very important. Before any businessman decides to invest from one location to another location, the most important thing which comes to the person's mind is taxation. And there comes the role of the chartered accountants, who provide the necessary input to the businesses. And there, the role of the chartered accountants, both from India and from Canada, is very significant in ensuring that the relationship, economic relationship between the two countries grow faster and faster. And here, the initiative which has been taken by ICAI from India as well as from Canada, and particularly Sanjay ji, is very, very commendable. I really appreciate the initiative which has been taken by him and the lead which has been taken by our friends in Canada. I'm sure this webinar will go a very big step towards ensuring that there is free flow of knowledge and experience from one to the other country to ensure that there is a smooth investment from one country to another country. With these words, Rishabh, I pass it on to you. Thank you.
Thank you, SP sir, for synthesizing it so well, the issue at hand and what we are going to do today. So I will begin with the formal introduction of the panelists today. So from Toronto, we have Akash Lakhotia, and he has more than 9 years of experience working as a public accounting, and his specialization, as correctly pointed out by Vivek sir, is in cross-border taxation. And yes, he has also done a global business management graduation from Canada. And we also have Dr. Rajendra Mantraji from Toronto. And he's a finance professional who has worked in various countries like Canada, US, India, and the Middle East. And he also holds a doctorate in finance management from the university in India. And he has been an active member of the chapter since 2008. And I think, yes, he was also the chairman for the period of 2018 and 19. Then from the Vancouver counterpart, we have CA Deepak Arora. He is an established chartered professional accountant. He is also the current chairman of the British Columbia chapter of ICAI. And he has more than 30 years of professional experience working into taxation. From India, we have CA Gaurav Singhal. He also has more than almost 2 decades of experience on hand working with international and corporate taxation. And he's also the co-founder of Saksham Ventures, which is a knowledge enterprise. He's a practicing chartered accountant in India. From Bangalore, we have K.R. Girish sir, who is also the founding member of International Tax Research and Analysis Foundation. He has more than 32 years of experience, and he has deliberated on international taxation comprehensively on various forums. And he is still in practice, and he's the past chairman of the Bangalore Chamber of Industry and Commerce. I formally welcome all the speakers here, and as per the schedule, I will ask Deepak Arora sir to start with the basics of Canadian taxation and what types of entities can we form over there, and take his discussion ahead. Deepak sir.
Thank you, Rishabh. Good morning and evening, everyone. First of all, thanks, Rishabh and Vivek and everyone for your kind words.
Sorry to interrupt, sir. Your volume is very low.
Is it okay now, Rishabh?
Yes, perfect.
Right. You want me to repeat it again? Okay, I will start. Good morning and evening, everyone. Today, I want to talk about and give my perspective on setting up of business in Canada. What are the major challenges and incentives we have? Before I start, I will give you an agenda. Can you move to next slide? Agenda
Sir,
for today.
Sir, sorry to interrupt again. I think your mic is moving a little bit because your voice is not very clear at some point.
Rishabh, is it okay now?
Yes, sounds very well. Sounds perfect,
okay.
Sir.
Okay. Otherwise, I have to log in again if something comes up like this. The agenda will be a general perspective and legal system in Canada. What different type of business vehicle and type of corporation we are going to have. Various options for non-resident and setting up of a corporation. What are the tax systems of corporation in Canada? Taxations of non-resident employees. So I'm going to majorly cover these topics on my slides. Next slide, please. For starting a business, generally we need to know about India and Canada. As all my professional colleagues, they are aware, As we know, India and Canada countries are known for their well-developed economies and stable political environment. Both nations encourage local and foreign investment, are known for the ease of setting up of business. However, there are huge difference in culture, way of conducting business and other conditions, as we need to understand which company is better for business perspective. We need to analyze the conditions, Canada versus India, which help to decide which place and which business is suitable. We all know location part. India is the largest nation in South Asia and share land borders with many countries and has a tie with various countries. Canada, we always say the nation has a high ranking for its ease of doing businesses. It has a very stable banking system, and Canada is readily available for skilled and educated workforces. And the nation has a reputation of low crime and poverty and excellent rail and road transportation and international airport. Our in Canada, the major industries are crude, petroleum, natural gas, and service sectors. I will go into company formation. Canada is known for their ease of doing business and encourages local and foreign investor. The entire process of forming a company generally takes 4 to 5 business days. Even if you can do it in one business day, it involves a single, simple, and easy process. Why you should incorporate a business in Canada? First of all, the high level of English proficiency among Indian give them a significant advantages over nations of many other countries. Settling in Canada with permanent residence has many advantages. The immigrant can live here, they can work in Canada for indefinite period of time. You can pick up any course, anything as you get permanent residency. You get access to world-class social and healthcare benefit of Canada. In addition to close proximity and similar culture, Canada is also second largest country by land and has the 10th largest economy. A well-educated workforce, wealth of natural resources, and free trade agreement with many of the world major economies make this a top choice for business investment. Before setting up a corporation, I will little bit give a brief about the legal system Canada has. Next slide, please. The Canadian legal system is based on both common law and civil law. All provinces and territories except Quebec has a legal system based on common law, while Quebec's legal system is based on a civil code. Canada operates a federal system in which the legislation powers are divided between federal government and provincial and territory. The federal government has jurisdiction over matters such as regulations of trade and commerce, criminal law, and on provincial and territory government have jurisdiction over hospital, education, property, and civil rights. So now let's move to a business vehicle. A non-resident who wanted to, or any person who wanted to incorporate a business in Canada, what type of options we are available? Can you move to next slide, please? The main focus of business vehicles used in Canada are sole proprietor, corporation, general partnership, limited partnership, unlimited liability corporations. I will not go into detail about these characteristics as they are similar to what we have in Canada, in India. So the structure is more or less same, but what is the difference about the process of forming and managing the business in Canada? I will go on more on this. As I told you earlier, you can incorporate a business in Canada in 4 to 5 business days. It involves a very simple process. Another simplicity is that we do not need any extra federal and provincial approval for authorized share capital or object clause. We have little bit in India, there is a more process to do it. We have to go registrar of companies or more formalities. Those type of formalities are not available over here. We can make a clause unlimited shares. So the process is very, very easy over here. Again, business license other than a specific industry is just a very simple process. We do not need any approval unless you go to a government regulated industries. Company existent formally is once you have incorporated the company, then you have to just report that the company is in existence once in a year. There is no other formalities, no other requirement, no filing of financial statement, nothing else. So matter is simple. There is no registration of director. Like we do not need any SIN number, TIN number, or anything. Once director is done, they are active, nothing has to be done. So sometime, not some, most of the time, I get a question as a foreigner, can I form a corporation in Canada? Yes, answer is very simple. Yes, client from US, China, India, Dubai, they all are approaching a professional like me or Lakhotia or another professionals to open either a subsidiary company or branch company. So there are, we will go into more into detail, but before that, I will give you a what different type of corporation we can do in Canada. Can you go to next slide, please? In Canada, generally, corporations are done at two levels, either at a federal corporation or a provincial corporation. Federal corporation is formed under a federal rules and regulation. This is again a simple process of forming, but there is a restriction that a director should be a Canadian resident. At least 25% of the director of federal corporation need to be a resident of Canada. So if you have a Canadian citizen or permanent resident, probably then it is a good option to form. Otherwise, you have to go a provincial corporation. Again, provincial corporations are regulated by each province. So most person who wanted to incorporate in Ontario or Alberta, they have a similar condition like federal corporation. But people generally like to either choose Ontario, Alberta, or BC. BC has one of the easiest way. Here you do not need any requirement what federal government and Ontario they have. They do not need any Canadian resident. You can form any person who is a non-resident. So those who are interested to form without any type in Canada, then BC Corporation may be one of the solution. In BC Corporation, the only requirement is to have a physical address in that province. In this case, either a professional like us or a lawyers, they can always come an agency agreement and they can put their address. So once it is done, then there is no other requirement for doing any for having a registered office over there. Now I will go into the basic understanding of Canadian incorporating process. In Canada, you can incorporate, as I have told you, either provincially or federally. A provincial corporation as well as federal are considered, both are considered as a Canadian corporation. Now you may have a question, if it is a provincial corporation, can I do business in Ontario? Suppose if you incorporate a company in BC, can I still do business in Ontario or Alberta? Yes, you can still do the business there. Wherever you have a PE and your office, that can be a main sources, and from there you can do all over Canada. But if you open an office in Ontario and you have a BC company, then certainly you need to go as an extra provincial registration over there and follow the routes over there. So practically, as a for a incorporation, there are two things. One is citizenship and residence rule. So basically, you need a director, you need an officer, a subsidiary corporation. So these are the two options which are available for the non-resident person to do business in Canada. What branch office is? A branch office is simply another location of the same business. A foreign company can open a branch office in Canada by registering as an extra provincial corporations in each jurisdictions where they wanted to do the business. The major advantage of this structure is that they have to merge their profit of Canadian into their parent company. And also foreign corporations are subject to withholding taxes. And there is another disadvantage of this, there is a branch tax. If you take the money out, you have to right away pay branch taxes. And it can be from 5% to 25%, depend upon the country where you have a tie-up. The another best option, which generally non-residents are taking, a subsidiary corporation. A subsidiary that has been incorporated anywhere in Canada, as we have discussed the options, is considered to be a resident in Canada for income tax purposes. It is again subject to federal and provincial territory regulations, and they are taxable for their worldwide income as comes as per the Canadian income tax. Any dividend is paid by the Canadian subsidiary to its non-resident shareholders will be subject to withholding taxes. If the shareholder has received dividend in which the country has no tax treaty, then it is generally around 25%, as most of the country they have. But if you have a tax treaties, it can reduce to 15% or lower, but generally it is a 15%. But Canada and US has a different tax treaty where if the dividend is received, then it can go even lower than 15%. If you have a certain rules and regulation done that you have a 10% voting rights, then it may go down to 5%. So the advantage of dividend withholding over the branch is that you can control more and defer payment of dividend if you have a subsidiary corporation. If you go to a branch office, you have to right away any income goes, you have to pay tax. And if you take the money out, then you have to pay branch tax. Again, if you incorporate a subsidiary company, you know that they are following local rules and regulations. So parent foreign companies are not exposed to any creditors or any other legal system. So you need to decide which option you wanted to go. But most of the people, those who want to do a regular business, they like to go for a subsidiary option. So let's talk about how a corporation can be set up. Next slide, please. So you have a two option for an incorporation. Either you go to a numbered company like 1, 2, 3, 4, 5, 6, or you go a name approval. Number approval is again very easy process. You can do right away in one day. You have to go online, file certain declarations, follow certain rules, and then you're ready. It can be done in few hours. If you go for a name approval, it takes 1 day to 15 days because the government wanted to ensure that there is no similar name. If you pay a priority services, you will get answer in 1 or 2 days. If you go to a normal process, it may take 10 to 15 days over there. But again, as the name is approved, the process is similar. You can incorporate the business in few hours. As I've explained earlier, a federal corporation require Canadian residents and shareholders. Can you go to next slide, please? Before this. One before this. That's okay. You can stay over there. Yeah, this is the slide. Advantages and disadvantages of setting up of a corporation. I was talking about that. Yeah, thank you. As the benefit for federal corporation, as I've told you, we require Canadian resident and shareholder, and it is regulated by Corporation Canada and has to be registered with the province where you are doing a business. So if you incorporate a federal corporation, then certainly you have to go with the federal rule regulation. And if you want to do a business in Ontario, then you have to follow Ontario rules and regulations, and you have to register over there as a extra provincial. If you do business, then you have in BC, then you have to follow the BC rules. So federal corporation require federal as well as provincial registration. Then the benefit of federal is that you have a one single name, you have a global recognition, you can have a meeting anywhere in the world. Federal corporation gives you more advantages of that part, but the only disadvantage is to having a Canadian resident director. In province, the other option of incorporation province, which we have discussed, it has its own rules and regulations. Like Ontario and Alberta, they require their registered office address in that province. And BC and Quebec allow non-resident directors, and they are very, very flexible. With discussion of the advantage and disadvantage of federal, we also need to understand what type of tax system in Canada for setting up a corporation. If you are planning to set up a corporation in Canada, so what type of taxes you are going to have that? Next slide, please. Next one. Thank you. The tax structure in Canada, I'm not going to go into detail because my colleagues from Toronto chapters, they are going to explain more in detail about this. I will just give you a more highlights what type of structure we have for the corporation. So resident are subject to Canadian income tax on their worldwide income, as we have in India. Non-residents are subject to Canadian income tax on compensation or amount attributable to service performed in Canada. The tax liability of corporations are actually, it has gone down from the earlier year, and it is between 26% to 30%, depend upon the province, depend upon the income you have. Most of the non-residents are paying tax between the 26% to 30%. However, if the non-resident decide to have a Canadian partner, then the tax rates will go down to 11% to 13,000 for first 500,000 of income. A person like me, Lakotia or Mantraji, if we are doing a business, we are for first 500,000 of net profit, we are paying around 11% to 13%. So these companies are called as a Canadian CCPC corporation, Canadian Controlled Private Corporation. So these corporation has certain criteria that you should have more than 50% Canadian shareholder. You should not be a public corporation. So there are some of the rules which need to be taken care to have this corporation. So some of the non-residents who have a tie-up over here, this may be an option, because instead of paying 26 or 31% tax, you can go with this and then you can make a call over there. So this is one of the options which non-residents have to make in mind if they wanted to work exclusively as a non-resident, or they wanted to tie up with the local and wanted to give some rights to them. Those type of things has to be taken care. So as others, business and proprietary income, it is taxable, which mostly, as we have in India, there are some of the special taxation parts are always on the basis of countries wise. In Canada, capital gain and losses, we receive a preferential treatment. Even in India, we have, I think, so a fixed 20% or something tax rate. In Canada, capital gain, basically we pay tax only on 50% of capital gains. Not if we have earned 100,000 as a capital gain on sale of property, we pay tax only on 50,000 as per the normal tax rate. The other 50,000, it is tax exempted. So this is one of the, again, benefits of having business over here. Deductibility of expenses, again, it's more or less each country has their own. But the major thing which the government has started now is the limitation of interest deductibility on loans between resident and for the non-residents. So that part has to be taken care. In Canada, we can, if there is any loss, certainly it can be adjusted against current year of the income of business. We can go back 3 years and we can go back next 20 years. So if you have a loss now, you can go back prior 3 years and take the taxes back, whatever you have paid. But if you are not able to cover up, you can carry forward this loss for next 20 years. So any profit which comes in next 20 years, that can be taken care under this. So this is one of the, again, benefit for having that you have an initial setup losses that can be always taken care. And this always help for my clients that initially 2, 3, 5 years they have losses, and in future when they start getting profit, they do not need to pay any taxes, and they are covering up all those losses. But again, if you sell the business, you can, on certain criteria, you can carry forward those losses. So in Canada, businesses are sold with the losses. Certainly, you will get some advantages on those parts. Next slide, please. The another important topic which most of our non-resident corporation wanted to know, how our taxations on non-resident employees. First of all, the people generally ask whether I need to hire an employees from Canada. No, you do not need to hire. There is no condition like in other countries that for incorporation you should have employees from here. So this is the biggest advantage in Canada. If you are doing an online business, you have nothing else, you do all from overseas, there is no problem at all. Follow the incorporation rules, and once you feel you are set up, you need both physical presence in Canada, then do it. So now I will go into a little bit about taxation of non-resident employees. Again, the taxation of employees of a branch depend upon where the employees are. If they are Canadian residents, certainly residencies, then they have to pay tax in Canada. If they are residents of India, then certainly they have to follow Indian rules. Whatever Indian rules and regulation require, that accordingly they have to pay tax. But generally, an individual is deemed to be in Canada or assumed if they are here for 183 days or more. If an employee he is working between both, then the dual residence and tax treaty rules will apply. So if an individual is a resident of Canada and he has gone to India and he becomes a resident of there, then we have to see what are the rules and regulation in tax treaties, which my professional colleagues will give more detail. So if there is a dual residency, wherever they have worked or whatever the rules and regulation is mentioned on the tax treaty, that has to be followed. If an employee move to Canada and become Canadian residents, then they are taxable to their worldwide income. Most of my clients, initially, they are doing business overseas, like they are setting up from overseas. Once they have set up their business, they are sending their employees to Canada, and then they are applying their PR, they are applying on their work permit, and the process is very simple comparative to have a the person who does not have these type of things. Employees who move to Canada and becomes Canadian, as I've told, they pay taxes on their worldwide income. And those who are non-resident of Canada, then they are taxed on their Canadian sources of income in Canada. And however, in some situations, like where we have a tie-up, then you may not need to pay taxes, or there may be a restriction. Just give you an example for US. Any amount paid to US citizen, maximum to 10,000, there is no rules. Even if they are in Canada, they don't need to pay tax over there. Now, some of the employees, like in India, we have a provident fund. Here we have a Canada pension plans. So when the employees are here on some deputation or some work, they can file a relevant form with the authority. They do not need to pay CPP as per Canada-India tax treaty, and they can pay only PF in India. So the similar reverse position applies over here. So tax treaty for employees becomes an important role, and this is one of the major resources for doing a business in Canada. So location, dual residency, and some of the exception I have discussed on this part. So next go to the last slides. In Canada, we have a corporate tax, we have a GST and a PST tax. The GST is more or less similar like in India, which has been started and doing very great. So GST is in some of the province, they have merged GST and PST, it becomes HST like Ontario. So this taxes varies between 5% to 15%, depend upon the province. I have highlighted some of the tax rates. Like BC has a 5% GST and 7% PST, and Ontario has a 13% HST. Alberta, they do not have PST at all. So you need to decide what type of industry you are doing it, whether it attracts GST or where should we go. Like GST always come back. If you have paid GST on purchase, on sale you charge, on purchase whatever you have paid, it will come back. So if you go to Ontario, if you pay PST 13%, it will come back. In BC, you will not get it. But some of the industries are exempted, like professional, like accountant, we are exempted from PST, but lawyers are not. So each province has their different rules and regulations. So GST, PST, they are again important role while you are planning to set up the corporation. So with this, last slide, please. Thank you. And I think so I've tried to cover up most of the topics related to incorporation, setting up of businesses, what are the rules and regulations. Now, my other professional colleagues will go in. Thank you, everyone.
Thank you, Deepak sir, to take us about the legal system, the corporate law, and the basics of direct and indirect taxation in Canada. And we are great to have you here for the insight. And now, can I request Dr. Rajendra Mantraji and Akash Lakhotia ji to continue and take us into the specifics of non-resident taxation and how it interplays with the double taxation avoidance agreement with India, and maybe have some certain focus on a few transactions which usually occur between India and Canada. Mantra sir and Lakhotia sir, over to you.
Sure. I think Raj Mantra ji, you will start. You guys can see my screen, right?
Yeah, I can see your screen. And thank you very much for giving us this opportunity. And I also want to thank Deepak Arora ji. You know, he covered most of our part also for the agency, you know, for the individual ones. Actually, you know, in Canada, the taxation is very much self-declaration. So having said that, you know, what that means that, you know, whatever we submit to the government, they accept it as it is. But with the reservation that they can come back and assess you again. So, like, for example, we filed our taxes, they will assess you and they will give you notice of assessment. And then having said that, you know, you are not done with that. You know, they can come back for next 6 years and, you know, they can reassess you. In any case, that's the first part of that, you know. So what I mean to say that, you know, I mean, it's very easygoing taxation here, not very cumbersome rules here. Okay, now for individuals, the taxation is based on the residency. There, you know, I mean, I will be like comparing between a little bit US and Canadian taxes. Once you are a permanent resident here, you are supposed to file your taxes. And then, you know, again, the taxes are based on the residency. Not apart from that, you know, you got the immigration and you are supposed to file. Then, you know, you have to see your ties. You know, what ties you have with Canada. And those ties can be primary and secondary ties. And the primary ties are very important to set up your status as maybe as a deemed resident, you know. So the primary residence, I will little bit focus on that. That primary ties can be, you know, your spouse if she is living here, or your kids are living here, and you have a house here. So those are your primary ties with Canada, and that will be very important, you know, to decide your status. And then secondary are, you know, you have like, for example, you left the country, but you still have a car here, or you have some furniture here, or you have some social ties, you know, like you have a member of any religious organization, or, you know, any Canadian recognition, you know, like how to say that, you know, the fitness center. And you have your bank account. Those are the soft ties. You know, you have still holding a Canadian driving license. So those are the things, you know, which will be help to determine your residency, and then the deemed residency apart from that. And once those are being decided, then, you know, the filing will come up. Like I said in the beginning, that, you know, if you are having a PR card, you are not legally bound to file your taxes. You know, you can be a non-resident. You know, and non-resident, there is another rules, you know, that if you are out of country for still having a PR card, but you are out of country for more than 183 days, and you don't have any primary ties, you know, so then you can be non-resident, and then you don't have to file your taxes unless until you have a Canadian income. If you have a Canadian source income, yes, of course you have to file, but it will be not like a resident tax. Versus when I was comparing again with the US, you know, if you have a green card holder, you are unfortunate there. You know, you don't have any status, residency status there. If you are a citizen or you are a green card holder, you have to file tax no matter what. And again, it's the income is the worldwide income. Of course, you know, there is a FTC, which foreign trade tax credits, you know, which Deepak ji also covered. You get the tax credit on your whatever the double taxation are there. If you are, you know, like worldwide income, you pay taxes in India, and your income from India is being also included in your Canadian taxes, but you will be getting the tax credit sometimes it does not come dollar to dollar. It is a probability. There's a form there. You have it is being calculated there that way. And unfortunately, Deepak also covered that federal and provincial taxes. Generally, federal taxes you get kind of 100% foreign tax credit like dollar to dollar, but provincial no. And the reason for that, because the provincial taxes has some components. Not only taxes, there is a insurance premium there too. Because there is being covered by the health. The 100% health is being covered by the government. So your taxes are are a part of insurance premium also there. So that portion you don't get the credit back. So apart from that, I would like to mention there is a non-resident taxes and for business tax rates. Deepak ji has covered this is a little bit in journal, but we are going to cover it more elaborately. Like CCPC, we have a condition there. That if you have a taxable income up to $500,000, there is a small business deduction you get it, and then your taxes will come 11.2%. Versus, there is a big difference between personal taxes and the corporations. Corporation taxes are, if you are a small business, then you can go up to 11.2, or if you are not, then you can go up to 26%. There is a, federal is started with 38%, but you get some abatements for that. And then, I was mentioned that personal taxes that can go up to 53%. 53 point some change. So then you have to decide it, which way you can go. You can incorporate yourself, or you can go in. Unfortunately, if you are doing a business, then of course it will be advisable to get incorporated. Or if you are working for a company, then you don't have any choices. You don't get any deduction for your expenses. When I say you can get incorporated and you can get deductions, but those are the legitimate expenses. Again, is the rule of the thumb is that all the expenses to earn $1, that is the legitimate expenses. It's not like that. You can expense your personal expenses. To earn that $1, whatever you expense, there is a legitimate expenses you can do it. And then there is a passive income rule also for non-CCPC, and there is a passive income can be like dividend income. So anything which is you don't earn by making hard work, or maybe with your hands. So those are the passive incomes. Those are being taxed on the high rates. Capital gain is a 50% is always including there, and there is no difference between long-term and short-term gain here. So it is all rated at the same places, and 50% of your the capital gain is included in your income tax. So having said that, I would like to mention one more thing, about the. Just give me a second. So I think for the residency, we have already covered that one. And anything else, Akash, you would like to take it over?
Perfect. Thank you so much, Mantraji, and thank you so much, Deepakji, for covering all the basics that applies to Canadian businesses. If you have a Canadian company, I think Deepakji and Mantraji covered all the bases. What I'm going to cover now is double taxation avoidance agreement and how DTAA plays role into any Canadian or Indian company who wants to invest in each other's country. There will be situation where both the countries would like to tax that corporation or an individual, but definitely both the governments reached out to an agreement and they made certain rules which apply to any company who is doing business and has placed of office or warehouse or any location at both the countries. Now, we'll keep our part specifically devoted to how business profits are taxed, and just building on to Mantraji's portion regarding what's the tax rate, what's CCPC and what's not CCPC. Assuming, let's say, there is a permanent establishment for Indian companies in Canada or vice versa, let's see how business profits are taxed. So first portion is definitely any business profits will be taxed in a country for the profits attributable to the permanent establishment in that country. And of course, for the business that is carried out through that permanent establishment. So our first phase is to see whether we have a permanent establishment or not. And at a later portion of my presentation, we'll go through what is a permanent establishment and what are the exclusions. Now, if we have a permanent establishment, we got to first see it's not that all the profits will be calculated as per the country's land. There are certain ins and outs depending on other provisions of DTAA. So we have certain clauses like no profits attributed to PE for simply purchase of goods for the enterprise. So for example, if I'm a company in India and have a PE in Canada, which could be just an office, right? And if that office is only used for purchase of goods on behalf of my head office without any markup, subject to transfer pricing rules, the portion of that income cannot be added to overall business profits that I earned from my permanent establishment. Where is it coming from? It's coming from DTAA. They have specific clause for this. In general, profits for that PE shall be calculated using same method each year, unless there is a good and sufficient reason to the contrary. So for example, it's very important how we start. And once we start, we got to ensure that consistency is followed each year, because in tax, we have enough experience to understand that there are always gray areas and there are always options to choose from, whether, let's say, is inventory valuation or any other provision. So we got to ensure that consistency is followed, and if there is any change in our methodology, there has to be a good and sufficient reason, or else any of the country's ministry will not accept it. Now, the Article 7 of DTAA between India and Canada provides some special provision for calculating business profits. First off, again, in general, whatever your country's land says, law of land says that you got to calculate business profits according to them. But then you have certain specific rules which should be added. For example, the first rule is any expense incurred by the PE, including executive and general administrative expenses, is allowable subject to laws of that country. Why it's important? Just to give you an idea, in Canada, any expense incurred on meals and entertainment, it's included only 50% as an expense, and 50% is not allowable. Similarly, we have other rules like life insurance premium of key personnel and executives. So if I have a PE in Canada, I'll first calculate the taxes as per the Canadian laws. And any expenses that's allowable, I'll take deduction. Okay. Then we have a specific provision regarding royalty, fees, commission, or interest charged or paid or received. So, for example, if a PE pays, PE in Canada pays royalty fees or similar payments or commission or other charges or interest to its head office, that portion cannot be deducted out of business profit. You'll say, why? This does not make sense, right? We have a rationale for it, because in order for these three heads to be deducted, we got to look into specific provision. We have special article in DTAA for royalty fees and included services. We have special article for commission, which is kind of included in fees for included services. We have a special article, Article 11, for interest paid by a PE to its head office or paid by head office to PE. So for these things, they won't form part of business profits. Rather, for these portions, they will form part of their specific article inclusions. And we got to look into taxability of these three heads separately based on those articles. They won't be clubbed under business profits. So these are kind of some provisions that needs to be looked at while calculating business profits. Then comes permanent establishment, which is, of course, very important and very significant portion of determination whether there is a permanent establishment in Canada or in India. So in order to understand whether a PE is indeed in presence or not, we'll first look into Article 5 of DTAA. Now, generally, all the DTAA has these concepts like a PE is where there's a fixed place of business. What is a fixed place of business? A place of management, a branch, an office, a factory, a retail outlet, and a site under construction with more than 120 days. So fixed place of business is a concept, of course, given by OECD that's applicable to almost all of the DTAA. There could be some exclusions, but in general, this concept will be consistent throughout all the countries. Second type of PE, again, a very common PE, it's called agency PE. What is an agency PE? If I have an employee who or an agent, let's say I'm a company from India. I have an employee or an agent in Canada who is habitually exercising an authority to enter into contracts on behalf of my corporation. So that employee or agent will form a PE for me. Of course, there are exclusions, but in general, he or she is a PE for me. Similarly, if that employer agent is habitually maintaining stock and regularly delivering goods on behalf of the enterprise, which is the head office in India, there would be a conclusion that that Indian company has a PE in Canada. And lastly, if he habitually secures order wholly or almost wholly for the enterprise, like we have an employee or a location or a business, or let's say subcontracted company, but that company is 100% dependent on us, and the only business they have is to serve us. Considering other rules, like there are some exclusions, they will normally be a PE for the Indian company. So we got to look into two things, whether there's a fixed place of business or there's an agency PE. Now we'll further look into what is not considered a PE, because PE is such a broad concept that it will be better to understand what's not a PE, and we can figure out whether our business activity fall into that exclusion. If not, it's highly likely that we have a PE in Canada, either Canada or India. Any fixed base of business or agency is not considered to be PE if it is solely for, like, we got to, I have given a specific weight on this word solely, that PE or a fixed place of business is only for, let's say, use of facility or maintenance of stock for storage, display, or occasional delivery of good, then it might fall under exclusion of a PE. If that fixed place of business is for maintenance of stock for processing by another enterprise and just facilitating the transportation, then it may fall under exclusion. Third point under fixed place of business will be maintenance of fixed place of business for purchasing goods or collecting info, advertising, and supply of information for scientific research or other related activities. So if your type of business falls into this criteria, then you don't have a PE. For agency PE, like I said, that there are exclusions, and the biggest exclusion if the agent is a broker or general commission agent or any other agent having independent status and deals at arm's length with the head office or the enterprise at the other contracting state, then that agent will not form part of, will not just to become a permanent establishment for the contracting enterprise. So we got to see the agent status, and dealing at arm's length is very important criteria for this. Now, once we, let's say we figured out for an Indian company, there's a permanent establishment in Canada. So as Deepakji and Mantraji has already highlighted that in Canada, it's two-tiered structure. There's a federal structure and provincial structure, and each province has its own taxes and rules. So my starting point, if I'm an Indian corporation, my first point will be to check DTAA and see whether I have a PE in Canada. And after I check DTAA, my next point will be to check Canadian income tax regulation to see in which province I have a PE, and how, if I have PE in multiple provinces, how the profits are attributed. It could be based on gross revenue, or it could be based on employees. There are certain rules under Canadian income tax regulation, 400 subsection 2 to 400 subsection 8, to determine attribution of income in different provinces. This is how you will be deciding how business profits will be taxed in Canada. So that's all about business profit. Now let's quickly touch base on the section which we excluded from business profits, which is royalty and technical service interest. Dividend is kind of different because it's anyways does not get deducted for business profits. So we'll cover these criteria very briefly, these areas very briefly, for which DTAA has specific articles. Now, for interest, royalties, dividends, how are they taxed? They are taxed in the receiving state. So if I'm an Indian corporation who is receiving money from Canada, don't worry about Canadian tax. And Canadians will have their foreign tax credit, withholding tax, which they will deduct. And then it's actually taxed in the receiving state. And the receiving state will get foreign tax credit subject to DTAA and their detailed provision. They will get foreign tax credit for the withholding taxes deducted by the other state. How much is the Canadian withholding tax rate? It's kind of more or less same for the other contracting state as well, but I'll more comment on Canadian side because I'm expert on that. Interest is on interest, Canadian corporation will have to deduct 15% withholding tax. For royalties and fees for included services, which is also called technical services, it's a range of 10, 15, and 20%, and it depends on certain factors. For example, if I'm paying royalty to a government organization or public sector company during first 5 years of its business, the tax rate is 10%, whereas then it jumps on to 20%. So depending on and also for the type of services, technical services, your rates are different. So definitely do refer to, I think it's Article 12 of DTAA, dealing with royalty and fees for included services, to see what rate applies to the type of services you are looking to provide to the other country. For dividends, I think Deepakji already mentioned, if you're the beneficial owner who is receiving the dividends from Canada controls more than 10% of the voting power of that Canadian corporation, then the withholding tax rate is 15%. In any other case, it's going to be 25% withholding taxes in Canada. And that finishes my portion and Dr. Mantra's portion of DTAA and business profit and related taxation. I'll pass on to Rishabh again to take it over.
And before Rishabh, I want to mention one more thing. I mean, we didn't put it in our agenda. If the shareholder withdraw the money and it is sitting as a debit, in their balance sheet, it is a very restrictive rules here in Canada, which we have to consider all the time. Because you cannot carry over a debit balance in the shareholder account. I mean, you cannot withdraw the money, just leaving it like there and just keeping in your pocket. Either you have to dispose it off, either way. Either you have to expense it out or you have to take it as a dividend. So you cannot leave the money, withdrawing the money and just keep it in your pocket forever. So the rule is that, before the end of the next year end, you have to dispose it off. Either way, either you have to deposit it back, or there are certain rules. You can withdraw the money. There are section 15.1 and 15.2 of Income Tax Act. Which we have to consider. So, but I just want to, just want to mention this thing. I mean, somebody is, trying to do the business here and try to, thinking that we can take the money and we invested the money and we can take the money back as it is. So it will not be possible. So that's it. Now it's over to Rishabh. And thank you very much, Akash. Having such a wonderful statements. Cannot hear, sir. Cannot hear.
Dr. Mantra, am I audible now?
Yeah, sure.
There is a section in income tax in India where if suppose there are two persons, A and B, maybe individual, maybe incorporated body, maybe anything, if they transfer their shares among themselves, then they have to transfer those shares on fair market value. If they are not transferring it on fair market value, then a deemed income is to be considered both in the hands of the seller as well as buyer. So is there any provision like this in Canada? Because the way you have explained that debit balance, in India also we have a deeming fiction like deemed dividend. Even if you are not keeping in your pocket, but if you are giving to an entity wherein some substantial shareholders are there, they are taxable in the hands of that shareholder if there is a distributable profit over there. So is there any provision like this also, deeming fictions?
Actually, for the intercompany, you can carry it over. I mean, so long as you can substantiate and you can prove that this is a really that you have given some for certain time or period. That you like an intercompany, the another company is your associated or is not associated even, and you have given a loan, and then there is a rule like you have like a what we call, there should be an agreement that when the money will come back and whether it's interest bearing or if it's not interest bearing. If it is interest bearing, there is a specific prescribed rules from the CRM is Canadian Revenue Agency. If you are within that rules, you are doing that loan, then it's okay. You don't have to worry about. But when I mentioned that section 15.1 and 15.2, that is specifically for the shareholders. I mean, the another point you was asking about that transferring the shares. Transferring the shares is still, we have the same kind of rule. It has to be business valued. I mean, in the beginning of the incorporation, you can do at par. Then there is a Akash can be more specific. There is a term called PUC, paid up capital. There is a valuation for that. There is a contributory surplus. I mean, of course, you cannot be taxed maybe on your individual hands, but the company will be taxed, but it can be deferred. So I mean, till it really actual transactions happen. And if I correctly remember, it is way back. I think when you're talking about the Indian Income Tax Act, there is a DNA. There was a section 54, I guess, if I correctly remember.
It is 56 now.
I mean, I'm very
close.
close.
Relating to capital gain.
Okay, so I'm very close then.
Yeah.
I left country in 93.
Yeah.
So I can just add a couple of points to that, to your question. That whether if there is a transfer of any asset between related parties without fair market value consideration, we have section 69 as well as what's called attribution rule of Canadian Income Tax Act. Whereas if you're not transferring at fair market value, you are still taxed at the fair market value, but there are chances, depending on situation, that the recipient will not get the increased cost base. They will have a lower cost base. Not only that, there are certain situations where, let's say, you are transferring without consideration or transferring to spouse, the income that's earned on those assets gets attributed back to the initial holder. Whereas, but there are certain advantages or other restrictions or other benefits where an income earned on an income will not get attributed back. So first stage income will get attributed back, but an income earned by reinvesting that income will still be taxed to the recipient. So yeah, there are some detailed and complex rules regarding that in Canada as well.
Thank you. Thank you.
I just wanted to add one thing on this, which Akash and Mantraji has said. Yes, if you transfer to your relative or another corporation, it is taxed like in India. But there are some of the options available, which Akash has said, that Section 85 or this is where you can defer those taxes and you can withdraw in each year. Like if you have a 1 million of value of 100 shares, you can convert it under Section 85 or 86, and then you keep withdrawing slowly. But yes, you have to follow the same rule like in India. And when you have a CCPC companies, if you sell share to someone, there's a lifelong capital gain exemption, like up to around 875,000. If today I sell my company share to Akash, I'm not going to sell, but if I try to sell, I may not need to pay any tax, up to 875,000 of consideration paid by him. Am I right, Akash?
There is a rule for specified shares. Deepakji, it's not that you cannot share any shares. There should be a specific rule.
Yeah.
There is a for specific shares. There is another rules. Akash can more elaborate on that.
So I'm just saying.
Yeah, I'll just keep it to the point. It's QSPC, but let's not go ahead. Otherwise, me, Mantraji, and Deepak will just take off it. I know, being considerate of the time, we have other panelists, so we'll just continue and maybe have a separate session.
No, actually, I took the advantage because our allocated time was finishing now. So that's why I fill it in.
Perfect. Thank you, Dr. Mantra and Akash ji, for taking us deeper into the Canadian tax aspects and also the relevant articles of the DTAA. And moving ahead, when we're talking about DTAA, can I request KR Girish sir to continue the discussion further and deliberate upon the ODI structures and how the investments are going to Canada and how they're supposed to go and what options are there. Girish sir.
Thanks, Rishabh. Mukta, can you? Yeah. Thank you. And good morning to you all there, friends. And I think a late good evening to friends in India. So as I'm going to touch upon predominantly on outbound from India, and that's going to be given the limited time, I'm going to talk only on that. And there is a reason for it, because Indian companies today we are seeing are fairly looking at opportunities across the globe. And Canada becomes interesting for Indian companies predominantly in the energy space. And a little bit in telecom, I would say. Telecom and energy would be the sectors which Indian companies would look at. And so my talk is going to be predominantly on covering that. How does Indian companies look at it, and what are the structures they broadly look at for investing into Canada? So, Mukta, let's go to the first one. There are some key changes in the ODI regime. So what recently RBI has done is they have relaxed the ODI regime, especially both ODI in the case of startups and in terms of eligibility of ODI to equity capital, and also in the form of financial commitments in the form of rollover guarantees. So given the paucity of time, I'm not going to delve very detailed into this, but broadly tell you like there is fair amount of relaxation which RBI has done in the very recent guidelines which they've used. So certainly an Indian company using a step-down subsidiary is encouraged, I would say, today more so than the previous regime. So time permitting, we will come back to this on the structures. But I think at this point of time, I'll leave it more as how Indian companies look at in terms of their outbound investments. Mukta, the next one. So yeah, this we have heard it. So I'm not going to dwell very much into this. except the, again, repeating, I think in terms of the Indian Canadian DTAA, in terms of the withholding tax on dividends, especially when does you get a concessional rate of a low withholding tax, and then an interest of interest. Specifically in respect of interest, I would really bring upon, because Canada, as I understand, introduced, changed the thin cap legislation in 2012. Because earlier it was a 2:1, now it's 1.5:1. So they made it more stringent, the using a debt structure for let's say investment into Canada, if somebody were to look at an opportunity of a target company in Canada. As regards the royalties is concerned, is by and large the same under Article 12 in most of the OECD countries. It's India-Canada Treaty also follows the same thing. I think you have a 10% on specific items on royalties, and other one in the case of 15%. So by and large is the same, and it doesn't have any, I would say, any specific exclusions or exemptions. What is more interesting is one which I would like to discuss a little bit in greater detail. The next slide, please. Is no. I think you just rushed the slide. I think the previous slide. The Canada-Barbados Treaty, I was just reading through for this presentation. It was a very interesting treaty. In fact, this is a more interesting treaty, both for inbound as well as outbound. Because from what I understand and then read through a lot of papers, is even Canadian residents use Barbados for their own tax structures outside of Canada. Similarly, when you look at an Indian company using an intermediate structure, the Barbados-Canada Treaty is pretty advantageous. Specifically, I think more than anything else, it has a similar characteristic of the erstwhile India-Mauritius Treaty, where you had the Article 13 benefit of capital gains. Because under the Barbados-Canada Treaty, capital gains on alienation of shares other than immovable property is taxable only in Barbados and not in Canada under the Barbados-Canada Treaty. That's a great advantage, especially of Indian companies looking at opportunities of investment of target companies into Canada, and then at an appropriate time, they want to exit out. And that's one interesting thing. Other one is more or less in line with the OECD countries, especially on withholding tax. And interestingly, what I also saw is Barbados also has a thin cap legislation, which was quite surprising for me, because normally tax havens don't have thin cap legislation, which is a bit surprising, but nevertheless Barbados has it. So you cannot use what I would say a debt structure for acquisition, because you have to be careful in structuring your debt structure for acquisition within the thin cap legislation. So that is one thing to be kept in mind. But this is something which I found it interesting, especially when you're dealing with an outbound structure for a target acquisition in Canada, or a target company set up in Canada using the Barbados as an intermediate jurisdiction. Next one, please. Mukta. Yeah. If you look at thin cap legislation, India introduced the thin cap legislation later, and then Indian thin cap legislation is based on certain parameters. Canada, as I mentioned, made the changes to the thin cap in 2012, and Barbados introduced a thin cap effective 1st September 2019. So basically, I think the thin cap legislation primarily is again used as using leveraging a debt structure for acquisition. So instead of purely through an equity. So that's where I think one has to keep in mind, especially when you're looking at opportunities of investment into another jurisdiction. And that's, in this case, we are talking about India, Canada. Because, and what I do understand, I think we don't have much statistics because I've also looked at the RBI statistics of outbound into Canada. There's not much, but I'm also going to talk about that in terms of numbers. But primarily what you see is, at this point of time, we are not seeing much of investment especially in, yeah, I just see Akash saying Canada has introduced new tin cap. Fine. Akash, you can later supplement that because I think I just finished off that. So what we have seen is not much of investment, both on the inbound as that is inbound into India from Canada and outbound. But going forward, I believe there will be opportunities for Indian companies looking at Canada for specific kind of businesses where they'll believe that there is an opportunities for growth. Because if I will recall, I think there was a 2020 McKinsey report which said that India will be the largest country which will have the largest number of transnational companies going forward. They're talking about the next decade. So I look at it more than inbound of Canadian companies investing into India. We would see more Indian companies looking at opportunities into Canada. And that's where I think these intermediate structures really play and then give the advantage. Next, please. Mukta? Yeah. Okay. If you look at the numbers are not too exciting, actually, if you look at it from an outbound perspective. This is the statistics which I took it from RBI, the FDI data, because in 21-22 fiscal year, it was $64.71 million into Canada. And inbound from Canada has been much lower than this, actually. So that's another interesting feature is it is Indian companies which are looking at opportunities in Canada. It's not, and not the other way around. Canadian companies investing into India, barring Fairfax Holdings or Prem Vatsa, I don't see any other really major Canadian investment into India. The next one is if you look at the data between April and July, it's on the increase. It's a tremendous increase. In fact, it has gone to $2 billion. So Indian companies have become progressive and looking at opportunities into Canada. So I would leave this audience with you and to say there would be opportunities for Indian companies to look at opportunities into Canada and not the other way around of Canadian companies looking at India, because that seems to be the statistics today. And I will leave it at that. And then as I have my other presenter, Gaurav, talking about it, then we will have a discussion on some of the specific issues. Over to you back, Rishabh.
Thank you, Girish sir, for putting this tangent of Barbados for investment in Canada. And taking ahead, can I request Gaurav sir now to enlighten us upon the changes in the tax treaty between India and Canada due to the ratification of MLI?
Certainly, and it is indeed an honor being a part of this gathering, an exciting opportunity here, and particularly an honor speaking right after Girish sir. This is a lifelong dream. The discussion will center around the agenda of the multilateral instrument, which has been signed by a number of countries, including Canada and India. And the Indian-Canadian Treaty is a covered tax agreement, as a result of which several of the key clauses of this treaty will be impacted. Some of them will be impacted at a very fundamental, might I use a word, at a philosophy level, at a policy level, something like MAP, for instance. But some of them will have a very direct implication to the extent that, even in the withholding tax rates in respect of certain transactions will change. So what I'm doing is we'll just quickly jump into the thick of the things. There are some slides for your readings, for your home reading, that what is the relevance of this multilateral instrument in general. What were the timelines like in respect of the Canada-Indian treaty? The important part about this timeline is it's here today, it's applicable today, it's enforced today, and all the transactions which are being undertaken between India and Canada, wherever we are judging their taxability in the light of the respective domestic laws and the double taxation over disagreement, we have to be mindful to check out the treaty as well. Before going into all those clauses which are affected by the MLI, I also want to highlight there are some very interesting clauses which in the MLI which are not incorporated into the Canadian-Indian Treaty. One of the most important clauses there is essentially the one which deals with artificial avoidance of PE status, such as the clauses which deal with plugging the loophole for commissioner arrangements, for specific activity exemption, abusing the preparatory or auxiliary activity clause, splitting of contracts, etc. But which are the clauses which have been affected by the MLI? Now, what you're looking at right now on your screen is the Article 10, Paragraph 2 of the Canadian-Indian Treaty. So the Article 10, which deals with taxation of dividend, is worded at a very high level. It is worded pretty much in a very rational, logical fashion, which is that the Paragraph 1 says that when one country's company declare dividends to the shareholder located in the other country, who's a resident of the other country, then firstly, this dividend will certainly be taxable in the state where the shareholder is resident. That's a primary tax, right? Paragraph 1, right? But Paragraph 2 says that the source country can also tax this dividend. Now, if in my example, assume hypothetically, right now, Girish was talking about a scenario where an Indian entity has made an outbound to the Canadian entity. For this discussion, I'm just flipping out the transaction a bit. Imagine a scenario where we are talking about an Indian company paying the dividend to a Canadian shareholder, right? In this scenario, Paragraph 2 says that India can deduct taxes, can apply taxes to the payment of dividend it makes to a Canadian shareholder, because this is the source state. But Paragraph A, subparagraph A of this paragraph actually gives a relaxation. While the treaty gives a general tax rate in respect of these dividends of 25%, which frankly is higher than the domestic tax law rate in India under Section 115A of 20%, but the treaty gives a benefit. The treaty says that forget the 25% rate written here in the treaty, naturally, forget the rate which is given in the domestic tax law of India too. This dividend will be taxed in India at the rate of 15%. But the condition is that the shareholder who's receiving this dividend should A, be a beneficial owner of that dividend, and B, should not be a minor shareholder. And when I'm saying minor, the threshold which is given here is a 10% threshold. So long as a Canadian shareholder is holding 10% or more of the voting power of an Indian company, then the dividend which will be declared by the Indian company to the Canadian shareholder will be subjected to a tax of only 15%, in contrast to the 25% rate given in the treaty, 20% rate given in the domestic tax law of India. Now, this is what has been there in the treaty for quite some time, but the MLI has changed it. Now, why has MLI changed it? Not necessarily in the context of Canadian-Indian treaty, but generally, OECD in its base erosion and profit shifting project, along with the integrated framework, felt that it's easy for companies to shift the shareholding momentarily to a company located in the corporate group. And that company should be located in that country, which prescribes a low tax rate in respect of dividend. You just do it immediately before the date of declaration of dividend, or just slightly before that, and benefit from this lower tax rate which is given in that specific treaty. In order to curb those kinds of tendencies, it said that we need to work something around, and that's what MLI seeks to achieve. The paragraph that you were reading just now was paragraph A of 10.2, and this paragraph is now modified. How has it been modified? It says, and the italicized part which you are reading is what is included in the CTA, in the double taxation avoidance agreement, thanks to the MLI. And it says that the 15% rate paragraph, right, Article 10.2A of this treaty shall apply only if the ownership condition, the 10% ownership condition, right, described in those provisions are met throughout a 365-day period that includes the date of payment of dividend. What I mean to say is, this paragraph seeks to achieve that just for the sake of enjoying a low tax rate, say the tax rate of 15% in this treaty, in contrast to another treaty which has a comparatively high tax rate, just to enjoy that 15% tax rate as against the domestic law of 20% and a higher tax rate given in another treaty. What if a shareholder in an Indian entity just momentarily transfers, for a few days transfers, for a few weeks or months transfers these shares in the Indian entity to a Canadian group entity, and then the Canadian entity enjoys this low tax rate of 15%, and then the shares go back to the original owner. And in that case, would the benefit be enjoyed by the Canadian entity, benefit of a low tax rate of 15%? And here, the answer now, thanks to the MLI, is not anymore. Why? Because in order to do that, the Canadian entity should continue to hold these shares for a total of at least 365 days, including the date on which the dividend is actually paid. Now, there are some interesting aspects that we can sort of, we can look into this clause. I want to compare this clause and want to draw the attention on how a Portugal treaty with India is worded. And this treaty is similar. I mean, in the sense that when we are talking about dividends taxation, the Indian-Portuguese treaty actually says that it prescribes a period of 2 years as against 365 days, which is okay. But the other important part is that these 2 years should be prior to the payment of dividend. Now, interestingly, the MLI does not say so. So therefore, what MLI says is that the shareholding should continue for 365 days. That includes the date of payment of dividend. But one thinks about it that it's not necessary that those 365 days should have got over by the time the dividend is declared, or that should be the last date. What I mean to say is, assume hypothetically that where a Canadian entity acquires the shares of an Indian company just a couple of days before the declaration of dividend, but then holds on to the Indian entity's shares for another 363 days, and now it finishes the 365 days condition, while it will be subjected to a withholding tax rate, which will not be 15%, because at the point of time of withholding, the 365 days condition is not met. But at the point of time when it will be filing its tax return, it can then claim that fine, for the withholding tax purposes, I did not meet the 365 days condition, but now I do. At the time of filing of return, I can now evidence, I can now prove that I have held on to those shares for more than 365 days. And therefore, now I am very well entitled. And therefore, I want a refund of taxes from the Indian government. Now, one might wonder that could be, probably, it could be the intent at the time of drafting of the MLI, that they probably meant prior to. But we will see that in the MLI itself, in one of the subsequent slides, there is a clause which creates a prior holding condition, but not this clause. So here's an example. For instance, a Canadian entity acquires 46% shares in an Indian company, but that acquisition happens on 8th of April 2022, whereas in July 2022, the Indian company declares dividend. And you have a question to answer that what should the TDS rate? Prior to the MLI, since there was no 365 days condition, there was only one condition, that A, the Canadian company should be beneficially holding more than 10% shares in the Indian company. It would have easily and happily enjoyed a 15% tax rate, but now not anymore, because as at the point of time when you have to decide the view about TDS rate, the 365 days condition has not been met. And therefore, in this case, the 15% rate will not be available. Treaty says 25%, but the domestic tax law says 20% plus surcharge and cess. So I guess you'll be going with the 20% and surcharge cess rate instead. Here are the two important changes, not just one change, two changes which are equally important, and they are to be read together. These changes are essentially made by the MLI to the Indian-Canadian treaty because A, they are minimum standards, right? And the idea behind these changes is to prevent the abuse by actions, by tendencies such as treaty shopping. At a very fundamental level, treaties are supposed to address double taxation, but sometimes treaties end up creating those scenarios which are double non-taxation. What I mean to say is, and the classical case, just now Girish referred to a scenario of India-Mauritius treaty, and now we were looking at a similar scenario of Barbados-Canada treaty, that where because of a treaty, the source state does not get taxing right, the resident state gets an exclusive taxing right. But what if the resident state doesn't bother taxing those kinds of income streams? For instance, in the case of the erstwhile India-Mauritius treaty, I'm talking about capital gain, which became a huge controversy. Now, that is an instance of double non-taxation. The question is double non-taxation an expected outcome, or is it an intended outcome of tax treaties? And the answer to that question by the OECD is that, look, if you are applying tax evasion or tax avoidance like tactics, then double tax non-taxation is not done. For which the first question was that this is something which goes to the philosophy of the treaties, but where is that philosophy written? Well, in some treaties case, old decisions say that you can look at Vox preparatories. These are the letters which are exchanged while the treaties are getting negotiated, but you hardly get access to the same. And really, ideally, something as basic as that should be mentioned right there in an official document, just like you have the preamble to the Constitution of India. Now, the MLI has ensured that there's a preamble to the treaties as well, to the tax treaties as well. And the MLI has ensured this through a minimum standard clause, because of which even the India-Canada treaty now says that what is the purpose of this treaty? It says, and the italicized part is the one which has been inserted. The purpose is intending to eliminate double taxation with respect to taxes covered in this treaty, agreed, without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping. So what I'm trying to say is that, and let's look at the Barbados-Canada Treaty again, because this treaty is also, interestingly, a covered tax agreement. It is also covered by MLI. It also has this exact same very preamble on top of it. And now that the preamble says that if using a tax avoidance or evasion device, a non-taxation is resulting, that is certainly not the object or purpose of this treaty. The other important anti-treaty shopping device, which has been inserted thanks to the MLI in the India-Canada Treaty, is the principal purpose test. And again, this is also a minimum standard. All the treaties which are covered tax agreement, all those treaties where both the contracting parties have agreed that the MLI will apply to that treaty, they will contain this test, because it's a minimum standard. And the principal purpose test is like the Shahenshah, the Badshah of even the domestic GAR, general anti-avoidance regulations. Firstly, and very interestingly, this clause supersedes all the provisions of any treaty, in this case, the Canada-India Treaty. It begins with saying that notwithstanding any provisions of this treaty, this agreement, a benefit under this agreement shall not be granted in respect of any item of income if it is reasonable to conclude, based upon the relevant facts and circumstances, that obtaining that specific benefit was one of the principal purpose of creating a particular arrangement, of entering into a particular kind of transaction, which resulted in a benefit, whether directly or indirectly, but it resulted into a benefit to a particular party. Unless one is able to establish that was something which was very much in accordance with the object and purpose of this treaty. Otherwise, if a particular arrangement has been created with one of the principal purposes being that we'll be able to avail this particular benefit, otherwise you wouldn't have been entitled to that benefit. That means it's an undue advantage. In that case, this clause supersedes all the clauses, all the provisions of the treaty, and it says we are not letting you enjoy the benefit of Canada-India Treaty just by using an arrangement which was principally driven with this desire to take this unintended benefit. Now, you might think that this sort of triggers the recollection of general anti-avoidance regulations even in the domestic tax law, right? The domestic tax law of India, at not one but two places, clearly states that when you have an impermissible avoidance arrangement, again, what is an impermissible avoidance arrangement? An arrangement, the main purpose of which is again to claim an undue advantage, then that advantage will be denied to you, and this GAR provision can supersede treaties, right? Then what is the difference? I mean, why do we think that a principal purpose test is a big deal? It's already there in GAR, and GAR has been in place since 2017-18. PPT has, or this MLI has come into force much later. But there are several striking differences, because of which PPT actually is far more, it carries a far more weightage, far more force than in comparison to even the general anti-avoidance regulations under the Indian tax laws. For example, in case of GARs, the condition is that not one of the principal purposes, but the main purpose of an arrangement should be to avail an undue tax advantage or tax benefit. As against that, the principal purpose test says that fine, you can have other principal purposes so long as any one of the principal purposes of an arrangement is to avail a tax benefit under the Canada-India Treaty, the benefit will be denied to you. Also, there are several administrative checks and balances. For instance, a GAR panel taking permission from the CIT before invoking a GAR. But if an assessing officer is invoking, if an Indian assessing officer is invoking the principal purpose test, not GAR, then there are no such administrative checks or balances, right? And therefore, it's easier for the Indian tax authorities to apply a principal purpose test as against a general anti-avoidance regulation. Interestingly, when actually the principal purpose test has a lower threshold. Also, the GAR provisions provide a lot of grandfathering, a lot of exemptions based upon monetary threshold. PPT has no such protection, no such exemption. So only if you can convince the tax authorities that a particular arrangement meets the object and purpose of the covered tax agreement, which frankly, in my personal view, is fairly subjective, then and then alone, you'll probably be able to avoid the bite of the principal purpose test. But other than that, I think the threshold for application of a principal purpose test is far lower. It's far easier for the revenue authorities to apply principal purpose test than even a general anti-avoidance regulations. The third change, which has been made by the MLI to the Canada-India Treaty, is the tiebreaker provision. Now, taking a step back, when do tiebreaker provisions, when do we require them? Where a person qualifies as a tax resident of both the parties, both Canada as well as India. That's when you have to figure out that this person is qualifying as a tax resident of both the countries. How do we figure out that finally, do we treat it as a tax resident of India or a tax resident of Canada? I'll give you an example actually. Imagine a scenario where because of the control test, India feels that a foreign entity which is controlled entirely from India in respect of all its strategic decision making is a tax resident in India, whereas Canadian tax authorities feel that the entity is after all incorporated in Canada and therefore it's a tax resident in Canada. In that case, what's the tiebreaker? The treaty so far before the MLI said that, look, if there is such a tiebreaker situation, it will be solved using mutual agreement. But what tests will be applied by the competent authorities of both the countries when they're examining this question in a mutual agreement proceeding? Those tests were not written here. What the OECD through the MLI has done is that it has made the change that it has listed out that which all tests will be relevant for the competent authorities of both the countries to figure out in a mutual agreement proceeding that whether an entity is a tax resident of Canada or that of India. And those tests fundamentally are, and not very surprisingly, frankly, place of effective management, place of incorporation, or other relevant factors which are not listed here. Also, another very interesting change which has happened because of the MLI is that while the erstwhile provision did not contain any maneuverability, any sort of flexibility, that in particular scenarios, in certain to certain extent and manner, competent authorities can give certain kinds of relaxations. The updated tiebreaker clause, that tiebreaker clause updated by the MLI, has that kind of a relaxation, which you see at the end highlighted in green. Now, what would be an interesting question, which we'll still have to see because there is no jurisprudence till now on that, is when one has to interpret the meaning of the expression place of effective management in this clause. Will you interpret the meaning of place of effective management as described by the CVDT in its Indian definition of place of effective management, which has some unique aspects which are generally missing worldwide, such as the active business test, or will you apply a general definition of place of effective management? And now, naturally, Indian tax authorities are going to take a position that, look, the place of effective management being a term which is not defined in the treaty has to be interpreted with reference to the act, right? But then that definition of effective management. Another change, which is something which has been present in a lot of treaties anyway, but was just not present in the Canada-India treaty, is now incorporated in the Indian-Canadian treaty. And what I'm talking about now is the capital gain which a person earns from selling the shares of a company, for instance, a company, but the company is essentially just a parking vehicle for an immovable property. Traditionally, most of the treaties say that, look, if a person, for instance, who's a resident in Canada, he is selling an immovable property located in India, then because the immovable property is located in India, well, the capital gains are to be paid in India. Capital gain tax is to be paid in India. But if that immovable property is parked in a company and then the property is actually sold by selling the shares of the company, then most of the treaties say that, look, it's practically the same case. So long as more than 50% of the value of the company is still derived from that immovable property which is located in India. The company may be located in any part of the world, not even necessarily India or Canada. It could be even a resident in a third state. Yet, the capital gain on sale of shares of that company will be taxable in India. Why? Because the immovable property, which is the value driver, is located in India. Now, this clause was missing in the Canada-India treaty. And that is what has been incorporated in this treaty with a 365-day condition nearly similar to the one that we discussed just now in the context of dividend transfer transactions. So essentially now, when a Canadian resident, any of your friends or clients who have migrated from India to Canada, but they continue to own certain immovable properties in India, but those immovable properties are, for instance, parked in a holding vehicle, such as a trust, such as a partnership, such as a company, then when its interests are sold, when those shares are sold, the capital gains will be very well taxable in India. This is a part which I was referring to towards the beginning, that this is a change which is more towards a philosophy of things. But yes, it's going to affect you and I very closely. We are talking about mutual agreement procedures. When do mutual agreement procedures get invoked? Where a taxpayer feels that the two countries, or any one of the two countries, are interpreting the treaty in such a fashion which is not actually supposed to be the intent of the treaty. In that case, that taxpayer, irrespective of any other remedy that he or she may have under the domestic tax law, can still go to the competent authority of a country and say that, look, I think you are interpreting the treaty wrongly. I think both of you countries, one is acting very aggressive, the second country is just not leaving any space, and as a result of which I'm getting squeezed. I'm paying a lot of tax in one country, the other country is saying that tax is not in accordance with the provisions of the treaty, therefore I will not give you a credit of that tax, as a result of which I'm actually getting subjected to double taxation or multiple layer taxation. Please solve this situation. This process is called mutual agreement procedure, but the reality, at least historically, has been that MAP proceedings used to take a lot of time. Now, what interestingly happened in this case, in Canada-India treaty, is that the Canada-India treaty has a condition that, look, the person who feels that he's getting this raw deal because of the misinterpretation by any one of the two countries or more of the treaty, he's getting a raw deal. He has to reach out to the competent authority and say that, look, I want to invoke MAP. Now, the Indian-Canadian treaty gave a deadline that within 2 years of the first notification of that action, which gives rise to this raw deal, which gives rise to this unfair taxation, this person has to reach out to the competent authorities, right? 2 years time, not beyond that. Thanks to the MLI, because that's a deal which is now being agreed by most of the countries. 3 years is now the time limit. So one gets 1 extra year to reach out to the competent authorities. That's pretty much it. And I hope I'm within the I'm within the 20 minutes timeline, bang on the dot. So Rishabh, I will pass the baton back to you, and that's it from my end.
Rishabh, I think I think Gaurav, wonderful presentation, Gaurav, of the MLI. The one other point which is relevant to note here is, unlike the India-US treaty and the MAP, we have the protocol for differing of taxes. The Indian-Canadian treaty, we don't have the protocol. I think that's one issue, because trade between India and Canada has not been much. I think it is only when the trade increases, you have the protocol for differing of taxes. And that's really the point under the India protocol. The second one is, anyhow, Akash, I wanted to check up with Akash, especially under the Barbados-Canada treaty, is there any new developments? You rightly pointed out that I think this is absolutely, the Barbados-Canada treaty is similar to our Article 13 of the India-Mauritius treaty, the erstwhile one, where there is a fair amount of investment coming into the country using Mauritius as an intermediate jurisdiction. And so from what I understand from Akash, because he has responded back to me in the chat, there is no really new developments. And another thing which, Gaurav, when you talked about it, I just wanted to bring out, I couldn't see, like the India-US treaty, we have the LOB clause and the India-Canadian treaty. You're right. I think, I hope I'm right on that. No, not that way. I think I could have missed out also. So there is no LOB under the India-Canadian treaty, because I think, again, probably the reasoning being is, again, I think it is still evolving, and it is not something which you have so much of transaction to clearing a dispute. Because even today, I think as you raise MAP, the maximum amount of MAP is actually India-US.
Yeah, absolutely.
Because I have personal experience. So I think it is India-US and no other country actually, because that's where the maximum trade is happening. This is the kind of trade between India and Canada is still to start. Eventually, I believe it will, because if you look at the ODI data of RBI, I think this particular period, we have crossed close to $2 billion. So it is really something interesting, especially for our friends in Canada, to look at opportunities and of Indian companies investing into Canada and looking at opportunities. That's the only thing I have to say. I think thanks for this opportunity, and it was, I think, it was a very interesting discussion, I would say. Except that I would have appreciated more participation, but doesn't matter. But that's not in our hands.
No, sir. Thank you to all the panelists for a wonderful presentation. Probably we received a few questions which remained unanswered, or they're like follow-up questions from the discussions, which I'll be taking up. So one question, I'm not sure about the India-Canada treaty, but I'm sure that in the OECD Model Convention, in the 2014 model, there was still some focus on the place of effective management for dual residency. But that was, I think, eventually removed in the 2017 model, but has been reintroduced again, some focus from the MLI, as you mentioned, Gaurav sir. So, I mean, is there some kind of confusion or deliberation about it?
The way I think about it is that the previous OECD model focused a bit more upon, in fact, focused a lot more upon POEM as the key driver to figure out the answer to the tiebreaker question. Whereas the new version that you see is actually in line with what BEPS has said, and therefore you see the same reflection in MLI as well. That keep POEM as one of the factors, but don't obsess only about that. Have the option for other factors also, as some of the drivers for deciding the tiebreaker scenario. So I don't think the way I would look at it is that there's no confusion. It's just that some of the treaties are evolving thanks to the MLI into this new version, and there are treaties which are not yet covered tax agreement, and therefore they still stick to POEM being the primary test, or maybe the only test to figure out the tiebreaker situation. I would request Girish sir to correct me if I'm wrong. Say you're muted.
Girisa, you are still on mute.
Yeah. Gaurav, I think I don't have anything further to add. I think I think you have aptly summarized it. I think that's the way I see it today. Because earlier the focus was predominantly, as you rightly said, was more on the poem. Now I think there is a slight kind of evolving. I think all of us, as we see in international tax, there is no. It is constantly evolving because I don't think there is no one kind of position one takes. In fact, I think there is. I think Gaurav would know this. There's a very serious thinking whether we should have, you scrap both the OECD and the UN, whether you should have a world model or a global model very different from the OECD and the UN. I think there is a different kind of thinking which is happening or being deliberated, but I don't know when it's going to come. But those of us who are in the subject, is always interesting when you deal with international tax that it's a constantly evolving stuff. So to answer you, Rishabh, I think Gaurav aptly summarized it. I think I don't have any different of opinion on that. I think that's the way it is.
Okay, thank you, sir. So there are a few more questions. One of it is like a general question that how to get expert knowledge of double tax avoidance agreements from India and about India.
Rishabh, I'm not going to answer this because there are two things. One is as part of the institute itself, because I was very involved in this whole the postgraduate diploma in international tax. It's a great program. I think that is one. The second is absolutely an opportunity to work on international tax. I think Gaurav can supplement me. Most of the people think, at least from India's side, this is what I have heard from a lot of people. They think international tax is Section 195. 195 is a procedural section to deal with. It's more a compliance kind of section that is not dealing with international tax. International tax is much beyond all this stuff, and so I think you to answer this question to whoever has asked it. Yes, he need to have first a good theoretical base and try to see that if he can work on some actual active engagements on international tax. That's how you learn.
Great. It is good to see that there are still participants like early in the morning from Canada. So this is a question from a Canadian participant for the Canadian panelists here. And it's a very specific question. It says that I am running a CCPC and outsourcing the work to people in India. Can I claim outsourcing fees as a deductible expense of the CCPC?
Akash, yes, it can be. Most of the people, we have outsourced our work, and it is a deductible expense. There is no problem at all. It should be a reasonable expense, and you are able to justify if the CRA asks that these are actual for these works. So any reasonable expenses is deductible in Canada, and you don't need to pay any. You don't need to deduct any TDS or anything. Suppose if I hire a person in Delhi or in India, and they are doing subcontract work for me, there is no TDS, nothing else. If they are performing those work in India itself, but if they are performing over here, then the local taxes rules will apply. Akash, if you want to add something on this.
I think, okay, go ahead, Akash. I think I was going to mention that NRT, Akash, you can go ahead.
Sure. Just to add that, of course, on if the transaction exceeds $1 million, there will be transfer pricing issues applicable. Other than that, again, you have outsourced. If it's at arm's length, they are independent agency. There is no question about PE as well, and it's also your cost source. So we're assuming you are not having sales or kind of getting contracts from India. So there are no other PE or taxation related issues so far as Canada is concerned. You can go ahead, Mantraji.
Mantra sir, are you having any comments on this?
I'm sorry, you're asking me something?
Yes, you were trying to add something. So I think.
No, I was saying, probably, there will be a non-resident tax, to be deducted, I mean, if you're making a payment, so probably, if somebody you are giving the funds to some non-resident Canadian, so you have to deduct some, again based on the treaty, that the tax has to be deposited, and you have to issue a summary report for that. We call it, non-resident T4, something like that.
Okay. So, sir, this is last question that we have, and I know we are over the board already with the time. But there's a participant who has asked that are there any industry-specific opportunities in Canada? Like in Malta, it offers a very conducive environment for crypto-based businesses, and in Singapore for holding companies. So are there any industry specific opportunities or incentives in Canada?
Rishabh, as per my knowledge, it's not much unless you go to some manufacturing area where the government is giving, but those are available only when you make a full-fledged subsidiary over here. There is like SRED, scientific research. There is a huge credit available if you are developing a product over here, but these are available to a Canadian control corporations. Even they have to follow certain rules and regulations. So it is if they are doing some activities and you follow under that. But because Canada is more of a service sector, so manufacturing, if they have that industry is giving it. Otherwise, generally it is not. As per my knowledge, unless Mantraji and Akash, you wanted to add something on this.
No, that's the only thing, SRED, or, you have some provincial test credits, but again, they are all available to the Canadian contents, I mean, I think, if I precisely remember, it should be more than 90% Canadian content, in order to get qualified. And there's, this is not only like, they call it SRED, but it can be more than that. It can be software development. It can be anything else also. It's not only like specifically like the name says, which is scientific, anything, or if you are developing any product also, even, I know I have one of my clients, they're developing, that marinated sauces, so they are also qualified for it. So anything, which has a new innovation actually, and has a Canadian content, then you qualified. And this is a very good amount, you get reimbursed, whatever you're spending is approximately, I think 90% you get reimbursed, and it has both, federally and provincially, both they have different, programs for that.
Great. So we are seeing very enthusiastic participation from our participants that we are still receiving questions. One of it is regarding the employees. So the question is, if an Indian entity employee goes for a business meeting to Canadian company who has outsourced the work to the Indian entity, then whether the travel expenses incurred for the travel and charged back later at a cost plus markup subject to withholding tax in Canada.
If I correctly understand the question, that somebody from India is traveling to Canada, right?
Yes.
And Canadian, they are reimbursing their expenses.
With the markup.
Okay, so with markup, I don't see any issues there.
Sorry, is this an employee of Canadian corporation or it's an independent agency?
It's an employee of an Indian entity to which the Canadian corporation was outsourcing the work.
Yeah, so it's assuming it's an arm's length independent agency. There's no withholding issues that will arise.
It's a simply reimbursement of expenses. It's not income, for the tax deduction.
It is with markup, sir. Dr. Mantra, hello.
Yeah.
That reimbursement includes a markup on that. So that includes something, a profit which is going to have an earning over there in India. I simply give you an example. Deepak bhai, you should also listen to it. If suppose I am doing a outsourcing work for you, an employee in India, if I go to you, I spend, let us say, $1,000 on my ticket, stay, etc. Now I come back in India and I charge you 125 or 1025. 25 is my markup. Are you going to deduct any withholding tax in Canada or not? This is precisely the question.
Agarwal Sahab, according to me, there is no taxes for the reimbursement if it is a business trip. If I am going to India or someone is coming from India for business trip, all those expenses, reimbursements are non-tax deductible, and even we can reimburse those expenses. The markup, if it is reasonable, the CRA has given some guideline for the employees, like $35 per day or something. Those are allowed. So they have no specific guideline on this. But if we go for our employees guideline, this is if you go for a travel, either you give the actual or there's a markup, I think so 35, 50, I don't remember amount. If they come within that, it is over and above will be treated as profit, because there is no specific, but that we have to see what criteria has been given to employees in Canada. So there is a guideline for the perks. So we have to follow that.
And again, Sanjay, the difference here, between the remuneration and reimbursement. So reimbursement is not subject to tax. Remuneration, yes.
Okay. So if it includes some profit, on that only the withholding tax at best can be deducted, nothing else.
I'm sorry, you was cut off in the beginning.
I say that as long as reimbursement of actual expenses is concerned, there is no withholding tax. However, if that includes some markup in the form of the profit, on that profit itself can be subject to at maximum.
I mean, again, Deepak ji just mentioned, it should be reasonable. If the markup is reasonable, it's still it will be considered as a reimbursement. Unless until you come into an audit preview, then probably it can be considered something else. Otherwise, generally speaking, no, reimbursement is not subject to any tax, even if there is a markup.
Okay, sir. So, Rishabh, you have any new question?
No, I think our question board is cleared now. And I thank our panelists for such an enlightening discussion and the host of topics that we have covered during this provided time of 2 hours. And it was great to have you all. Now, can I request the Vice Chairman of the committee, Kotha Srinivas sir, to give the concluding remarks?
Thank you, Rishabh, and I thank all the enlightened panelists who have enlightened all the participants across India and Canada. I thank Deepak Arora sir, Akash Lakosia, Dr. Raj Mantra, and locally K.R. Giri sir and Gaurav Singhal sir. Definitely, it was a great insight for participants where they came to know about India, Canada, DTAA, and also the perspective how to, like if they want to practice in Canada or if they want to make investment in Canada, what all the precautions that has to be done. It's of course a precursor, what we have done. It's a good beginning. So if people show interest and we can have more programs on this, especially with India and Canada, as Girish sir was saying, the investments to Canada is less compared to USA as such, with India and Canada. And as we have this MRA between India and Canada also, so with the more and more programs, we can encourage our members to take up that CPA Canada course. And as initially, I think Deepak Arora sir said that they help all the budding chartered accountants who wants to take up that course of CPA Canada. So this we will keep it in mind, sir. And next month we have convocations across India. Maybe we will inform them that this is one thing where we have a chapter in Canada, and if any chartered accountant, freshly qualified chartered accountant would like to take up this CPA Canada course, we can definitely take their names and provide to you so that you can help them out in coming and completing that course and also establishing. And recently we got a letter from the ministry where we can even earlier we were doing accounting and bookkeeping. Now they are allowing us to do auditing also under free trade. What do you call this zone as such? So maybe at Canada, UK, and European unions we can do it. So there'll be a wide market that will be opened up for people, professionals in India and Canada. So definitely we will continue this relationship what we have started. I should thank the Committee of International Taxation, the chairman, and also Rishabh has taken this initiative to organize this. Let us do more programs and see that we will help the professionals both at Canada and India at large. Thank you once again. It's a good night from India and good morning to Canadian members and ANCO members. Thank you. Jai Hind.
May I specially request Ganesh sir to say last few words, as you are always the inspiration for young buddies and everyone who comes there. I can still remember that in 2018 you took me specially drive, and you can say and my wife still remember those days. So any concluding guidance or you wanted to give to younger people, because a lot of people will see this video later on in India as well as in Canada and other part of the countries.
No, definitely. Thank you, Sanjay Bhai. I can definitely say a few words. So first of all, please, all fellow professionals, please remember that there is a community of your fellow Indian chartered accountants settled here, be it Western Canada or be Eastern Canada. When I say Western Canada, I mean British Columbia, Vancouver, where our chapter is established, which is British Columbia. And Eastern Canada would be Toronto, so where we have Toronto chapter of ICAI. So both of these chapters are very happy to help any CA professional brother or sister who wants to immigrate to Canada. They're coming from India, they're coming from any part of globally from wherever. So we are really kind of helping them of course, like settling down, which is like giving them job references, helping them prepare for their CPA examinations, even helping them find like accommodation. So not only for them, but also for their spouses. So we are happy to help in that. And also in case, like Sanjay Bhai mentioned earlier, so if other than on taxation, if you guys are interested in something like IT security, information technology auditing, application controls, ERP, what are the courses that should be done? I think that, I mean, what has made us successful here in Canada. So we are happy to share those things with any of our member. Please feel free to connect with us. Our information is available on respective websites. And you can call us, you can email us. So please feel free. And if there's anything, Sanjay brother, if I missed anything, so I'm happy to speak about, but call us anytime, no worry. You can call us at WhatsApp, you can call us at phone, email, whatever. So we are available.
Thank you. Thanks a lot. I think, may I request the control room to conclude the proceedings with thanks to everyone. Let us come again and now discuss later on in the second part, the complexities also.
Thank you, everyone.